Hey, what's up everyone? This is Silver Slayer. Thank you for tuning into this video. Before we go on to the main video, I want to mention another silver giveaway. You can actually win a tube of 25 brand new Britannias. It's a tube of the 2020 Britannias, and it comes with 25 coins. So that's 25 ounces of silver. You could be one of 20 winners. That's right, they're giving away an entire monster box of these from SD Bullion. All you have to do is click the link in my description and enter your email address, and then click submit, and you have entered. Very, very simple rules to win, and who wouldn't want a free brand new tube of Britannias? I mean, and it comes with 25. Normal American Eagles only come with 20. I could have been greedy and said, you know, I'm not going to share this to my subscribers because then I have a better chance of winning. But anyone who's watching this video, I would feel just as good if you won as if I won. You know, we're all family, and if I'm going to be entering a giveaway, I'm definitely going to be sharing it with my audience as well. So, on that note, we have an article from Seeking Alpha talking about the gold bullion stage's major breakouts. And this is from March 3rd. This was written today, though. He's talking about March 3rd, the Federal Reserve cutting interest rates, what happened, and what's going on with gold, how there's so much potential in it. It's definitely a very, very good article. I think you guys will enjoy it. So before we start, make sure to smash that like button. Make sure you subscribe if you're new, because I do post daily videos. That's right, every single day, at least 2 to 3 videos per day. I'm sitting here busting my butt. So please like the videos. It means a lot to me. Anyways, let's jump into this article. So on March 3rd, the U.S. Federal Reserve made a surprise emergency cut in interest rates, taking the Fed funds rate down 50 basis points to a range of 1% to 1.25%. The rate cut means an immediate positive impact on gold bullion and gold equities, including silver. And anytime I'm saying gold, you can replace it with silver as well. Primarily the fundamental driver we see for gold equities is the enormous earnings for growth. There are many consequences of further rate cuts, but for gold, the level of real yields is the most important by far. We remain convinced that sustained deep negative real interest rates will be the primary tool for financial repression. So, the U.S. Federal Reserve, the Fed, quote-unquote, made a surprise interest rate cut of 50 basis points on Tuesday, March 3rd. See, the gold bullion closed the week higher, above $1,670. This follows gold's February breakout from the critical $1,585 to $1,600 level overheat resistance range that we've highlighted for several months. So you can see right here, gold bullion, silver bullion, the change. See, silver is more volatile, so the changes are going to be much more drastic and dramatic than gold is, but you can see all through here. So coronavirus outbreaks worsens, and this is because of the unknown variable that we don't know the extent. I've talked a lot about this on the channel. YouTube really doesn't like saying this word, so I try to say COVID-19 because I don't know why, but they definitely blacklisted that word to some extent. But anyways, COVID-19 outbreak has worsened to now more than 95,000 infected worldwide and has spread globally. The threat of the COVID-19 virus on global economic growth has now impacted all asset classes, global trade, liquidity, and central bank policies. It was in mid-February when the severity of the economic impact of the coronavirus began to be reflected by major companies such as Apple, NASDAQ, AAPL, when it provided earnings warnings. And for several weeks, major parts of China were locked down, closing businesses to contain the outbreak. But a side point now, they mentioned that this is not containable. They cannot contain it, which is even more scary. So, you know, they're kind of just summarizing COVID-19 right now. But the impact was a reminder of how important China is in the global supply chain and its impact on global growth. Yields fell, yield curves flattened and inverted, and inflation expectations rolled over and commodity prices collapsed. And this definitely is so true because this exposed how weak our economy really is, especially without China, but more importantly, how much debt we really are, because we need the Federal Reserve, we need central banks to step in and put that cushion, that comfort, because if not, then a recession is knocking on the door, and that would be the icing on the cake. See, all asset classes were confirming the severe impact of the coronavirus outbreak on global growth, except for equity markets, which were making new highs as expectations were for more liquidity stimulus. stimulus. And by last week of February, equity markets finally sold off in spectacular manner, putting some of the worst multi-day sell-offs in several years. Systematic funds flow and CTA commodity trading advisors, example quant funds and investment fund that selects securities using advanced quantitative analysis. See, repositioning were main drivers for this price action. The enormous amount of selling, some of the highest trading values recorded, morphed into systematic selling event, taking down gold bullion on the last day of trading of the month as liquidity available for profits taken became scarce. See, this actually helped boost gold prices. The Fed rate cut boosts gold. So on March 3rd, the U.S. Federal Reserve made a surprise emergency cut in interest rates, taking the Fed funds rates down 50 basis points to a range of 1% to 1.25%. The rate cut made an immediate positive impact on gold bullion and gold equities, which we're just explaining from, they did this because of COVID-19. Gold bullion broke out of the $1,585 level to $1,600 level, overheat resistance range in February that we've seen highlighted for several months. Gold bullion traded as high as almost $1,700, its highest level since 2013. The breakout through that level, it occurred as an impulsive thrust to flight safety event. Gold was consolidating into $1,630 level to $1,660 range until last day of the month before it fell $59. See, gold sold off for several reasons, mostly due to systematic factors. First, because it was a source of liquidity that still had a meaningful profit. Gold was a significant portfolio weight in systematic funds and CTAs, and all these funds were de-risking, deleveraging, and bringing down exposure after the S&P 5005 was down more than 12%. From all-time highs and gold bullion was still up 8.4% year to date. And the source of the proceeds was obvious. Gold and ETF holdings, however, closed their all-time high in comparison as they were not under any pressure to sell. See, that's the difference between the two. We have seen this liquidity forced selling before over the years. Most notable was in 2008. So they're explaining all that. So after the emergency rate cut, gold bullion closed at the $1,640 level. Back to recent trading range. There are several technical price points we will be watching. The $1,675 level, $1,750 level, and $1,800 level. We would expect some more consolidation to occur between $1,600 and $1,800 before we retest all-time highs at $1,921. So we see some levels we have to keep an eye out. So $1,600 to $1,800 expected trading range. So that's what they're talking about right here. Right now, gold is sitting around this range, so we definitely have an eye on it. Gold equity earnings, potential for enormous growth. Gold equities traded up to the cusp of a major breakout level before falling back, caught in the market vortex of the all-systematic selling. Generally, the broad markets are selling off aggressively and volatility spikes. Liquidity conditions force equity correlations essentially go to 1. Everything goes down. After the storm, stocks revert to their primary fundamental drivers in time. So the primary fundamental driver we see for gold equities is the enormous earning growth, that's money. The average gold bullion price in the fourth quarter of 2019 was $1,483. The quarter-to-date average of gold is around $1,578, an increase of $95 an ounce, or 6.4%. As a reminder of gold companies' operational leverage to higher gold prices, we highlighted the following example using an industry average AISC, an all-in sustaining cost, of $975 per ounce. So, anyways, I'm going to kind of go down here. So, let's talk about where's it at? Yeah, the bond yields fall to all-time lows. Financial repression has arrived. This is really where I wanted to go with this article as well. U.S. yields fell to new lows as global growth outlook worsened. The U.S. 10-year yield set an all-time low tick of 0.9% shortly after the federal emergency rate cut. See, this has a rippling effect. Prior to the rate cut, the 10-year, 3-month yield curve inverted, signaling a heightened recession risk in the next 12 to 18 months. The U.S. 30-year 30-year yields closed at an all-time low of 1.5%. U.S. year break-even yield, a measured growth expectation, has completed a large top. So there are many consequences of further rate cuts, but for gold, the level of yields is the most important by far. So this is talking about all the rippling effect afterwards, which I mentioned earlier. In Figure 3, we highlighted the correlation, and this is Figure 3 down here. We highlighted the correlation of gold with real estate. With real rates. Since the beginning of the credit crisis in 2007, the long-term correlation of real interest rates. If gold bullion is down 0.89%, an extremely high level, of correlation. See, even R square of this period is 82%, a very high level. After the emergency rate cut, the level of negative yields is now firmly in the range of financial repression. If the Fed cuts rate by another 50 basis point in April is expected, this 10-year TIPS Treasury inflation protected securities yield will fall below its low of 2012 at the negative 1% level. And it will be apparent that all we have entered in the state of financial repression. It will become more negative along with more rate cuts. We begin to see the expected fiscal policy measures. So you can see this right here. See, the gold part is the gold commodities, and this is the USG 10-year index. So you can see how, they're opposing each other. So this goes into how the U.S. dollar strengthened, but I'm going to wrap this up here. I just wanted to, those were the main things I wanted to highlight in this article. But going back to the giveaway, also, if you wanted a chance to win some free silver, go do that. Both of these links to these articles will be in the description. All you got to do is click it. It'll say Silver Britannia giveaway. All you got to do is submit your email, and you can enter right there. A chance to win 25 ounces of silver, the biggest giveaway I've ever seen. I've done some big giveaways in the past, but nothing like this, I don't think. I might have, actually, knowing me back in the earlier days. I used to do crazy giveaways, but yeah, anyways, I just wanted to share that with you, because if I was going to enter the giveaway, I definitely want you to have a chance as well. And also wanted to share this article talking about everything that's going on with the Federal Reserve cutting interest rates and how this implies with gold and where the prices could be headed. So anyways, thanks for tuning in this video. This was Silver Slayer. I'll see you guys soon. Peace.